Thanks for joining us today. We're going to go through a recap of the third quarter, kind of answer some questions that did come in. And format for this, we have about 7 or 8 things that we know we're going to touch base on, and then we'll see if any other questions come in while we're having the conversation that we can jump into. But we'll probably spend a couple minutes on each one. If you have any questions, you can type them in the chat box, and we can we'll respond to those as we're going. We have Melody and Natalie here too. So questions that come in, we'll be able to handle and talk about as we go through the conversation. So from an end of quarter standpoint, the third quarter, we had our highest occupancy we've had. We had probably our best collections. We don't really have much delinquency across the portfolio. We signed the most leases. Every retail deal paid out. So overall, it was very successful. So that's kind of what we're kicking off with and going into here. But we did get some questions. Oh, and we had questions on distributions, but we're always sending those out on the 20th. The 20th of every quarter.
And you like questions, so we should encourage people.
Yeah, we like questions. It's a good discussion, especially if we get good challenging ones.
So they get sent out on the 20th, but they actually arrive in the bank account. It takes like 2 to 3 days to process. So
yes.
So this quarter they were sent out on a Thursday. So they usually, I think they hit most people.
Monday,
most people got them on Monday.
Yeah. And IRAs, we use equity trust as the bulk of our IRAs, but we're sending them our deposit slips ahead of time. We send them, we try and get them to do it as fast as possible, but they are slower than the ACH process at a bank. But yeah, that's overall out the door. They hit pretty quick. And we'll do that again in December when we finish our fourth quarter. All the statements, everything will go out on January 20th. I don't know what day of the week that is, but they'll all go out on January 20th. And the statements or everything are loaded into Juniper at that time. So a couple questions we're going to start with right away is the first one that someone asked that a lot of our recent deals that we've done 1031s, we've also been sending out information on these TIC agreements that we're doing. And the question is really like, what are these TIC agreements and how do they have oversight of the 1031s that rolled in, and really where do they play in that? I think it's kind of twofold. It's the 1031s and then what the TIC is. Right. So we've done a lot of 1031.
Yeah. So 1031 is an amazing thing about real estate that doesn't exist in other businesses, right? And I think the last tax change actually got rid of a lot of the exchanges for other businesses other than real estate. But the 1031 is still very much alive and intact that allows people to basically invest in real estate, capture depreciation while they hold it, sell it, make money, and defer all their taxes as long as they buy another piece of real estate in 180 days, right?
You're paying no tax on the capital gain.
Exactly.
And a lot of times we're doing 1031s either in-house or pushing Greenleaf deals forward. So we're selling a Greenleaf deal, buying a new Greenleaf deal via 1031 exchange to defer those taxes. And other times we're taking outside 1031 capital from somebody who might have sold a condo in Miami or another investment property. And so these amounts vary too. And we did a record number of those this year too.
Right. And that's where this TIC, which is tenants in common ownership, comes into play. Is a lot of the times in 1031, you don't fully utilize all the dollars in it. Or if you have a 1031 for an exact amount, it's hard to go find a deal that is exactly the perfect size for that.
Well, one technical point on 1031 is different than an investor coming into a deal. So all you guys have invested with us, have come into deals, and you come in under an operating agreement, and we all have the terms of the operating agreement, how we work together. There's a general partner, usually the 3 of us sitting here, and there's limited partners, which is basically the money. 1031s are different because they actually have to take title. So if you own a condo in Miami and you sell it, you make a bunch of money, and you want to come into one of our deals, you actually have to. You can't come into an operating agreement with everyone else. You have to come into the title, and you have to be there on closing day. You have to be part of the closing process.
You mean the title of the asset?
The title of the asset.
Right.
So
exactly.
your name is actually on the tax records as an owner of this property. And that's part of the issue.
You're not coming through as an LP into an LLC that we set up. So you're physically taking, it's called taking title. You're putting your name on that title alongside one of our entities that's also putting their name on that title. And
right.
That's where the tenants in common.
Yeah, it's basically the new operating agreement. It's just a different format of an operating agreement. Instead of our current operating agreement that says general partners, limited partners, here's how we all work together. A tenants in common agreement is showing that all the people take title to one asset. It's how we work together.
So the money flow is still is still the same. It's coming out of a deal that we purchase based on pro rata ownership for each tenant, right? In this case, 2 1031s. And then the money flows to those individual 1031s, and all the operating agreement components that were in there originally stay with that deal. So they kind of flow through the years, and the operating components stay the same.
And important too, that each tenant, each side of the tick actually has a percentage ownership. So there's always a fixed percentage of ownership. So one of the deals we just closed, like one side was about 12% and one side was 88% and 80. And then that percentage exists for the lifetime of purchase.
Right. Yeah. Yeah. It can't change.
Right.
So I hope that answers. I mean, if there's any other thoughts on ticks or 1031s and how they work together, we've done quite a few of them. We have multiple deals that are
What-
are deep into the 1031s of 2, 3, 4 times. We've done the same 1031.
Right. It was one thing to comment on regarding 1031. It's not just the capital gain. It's also all that depreciation recapture. So specifically, when we're selling some mobile home parks right now, we realize a ton of depreciation on those assets. I think we got to write off a very significant part of the asset in year one because of the actual mobile homes themselves. If we were to sell that and not 1031, we would not only have the gain from the profit that we made on selling the property, but we also have to recapture all that depreciation that we took early on. So
And pay tax.
And pay tax on both.
Depreciation recapture
That would
tax.
not be a fun year,
no, it would not be a fun year.
a fun tax year.
Well, the good news is they only make you pay taxes on profits.
Right.
So if you're making money and you've been paying taxes,
Good
but you can
problems.
defer those, right? That's the
Yeah.
point of the 1031.
Yeah.
And the tick really outlines how we work together with multiple tax deferred 1031s, or even a fresh equity that can come in. The tick doesn't have to be 1031s. Fresh equity too, that comes into a deal.
Right.
So a lot of our deals that we have done this year have had this tick arrangement. And when you see it in our operating agreements, or when you see it in Juniper, where it shows, which is our investment software, where it shows a percentage ownership of a whole deal, that's what that is implying. So we had another question here. It says, it looks like we signed a good amount of leases in the third quarter. Are you concerned with rising inflation and specifically on flex space? So I think that this question is around, we did sign a lot of leases in the flex space, and we're signing 3, 5, 7-year leases. And what's going to happen if inflation is at 10 or whatever percent they're going to report it at going forwards for multiple years?
And one of the theories we brought up on our industrial discussion was some of the impetus from all these leases being signed is that our tenants are trying to get ahead of inflation and rental growth and trying to lock in their fixed costs. And at the same time, we're trying to be conscious of that, but occupy our buildings. So a lot of our flex leases we have baked in. So 2 big things, right, is 4% annual escalations. On the lower end, we get 3%. On the higher end, we get 4%. But most are signing 4%. Number one. Number two is they're mostly triple net leases, meaning that we pass through all the operating expenses to the tenant. So as inflation impacts our operating expenses, we get to pass those all along to the tenants as we go.
Right. And that 3 to 4%, we kind of look at that. That's still below what inflation is right now. Inflation was 8.3% last month, down from like 9%. But that 3 to 4% is well above what it was just 12 months ago.
Well, historical inflation is roughly 2 or 3%, I thought,
Yeah.
over the years. So if you just last 50 years,
Reported inflation over the time, whatever you actually believe it is, may be
Yeah.
different. But yeah, it's almost like we're getting 3 or 4%, which is twice what it was 12 months ago. 12 months ago was around 2% or 1.5% that you could easily get in a 3 or 5 year lease. So now we're getting 3 or 4%, which isn't fully catching inflation, but it's also giving us occupancy now. As inflation drives those rents higher, we would then be able to renew a lease in the future and capture that higher rental rate gain. So it's kind of, when I think about this, like there is a concern of signing super long leases with no rental rate increases. That's not something we would be normally doing. But we also don't have daily turnover like a hotel, where hotels can capture inflation growth instantaneously. They change their room rate for tomorrow. In industrial, we're looking at 3 to 5 year bumps. We're buying a deal right now with the rents are $2 a square foot, $2 to $3 a square foot, and the market is 12 in a specific area where it's at. I mean, that's a big, and we're buying that with tenants in place that are gonna move, and we're gonna release at much higher rates.
Exactly.
So I would say, in short, yes, we're definitely concerned about signing long-term leases without any kind of gain associated with them. But in the short term, we're getting good rental rate increases. Our debt is fixed, so we're just increasing our cash flow and our margins on our leases and increased occupancy. Okay. Go ahead. Another question here on the cash that we have on our balance sheet. And this was around a specific deal. Some of our deals, we have a lot of cash reserves, but the question was, what are we doing about interest rates with our cash? Or are we able to actually earn any money on these? So there's a couple situations going on with that where we have reserves that are held at banks. I mean, I guess obviously they're held at banks, but they're held at the lender. And those ones are kind of controlled by what the lender sees. And we have our cash that we have for the most part in money market accounts. That's paying 1.5%.
Well, which is better than 0.1% than it was paying last year.
Correct. 0.01%.
And everything retail is holding right now. I mean, it does go up and down. So it's a cash account that we only need money for. Maybe every 6 months we might do something with it, or once a year we have to pay a tax bill. And so that's what we're generally holding those reserve funds for. And so it's hard to open up a 1-year CD on those reserves if you have to write a tax bill or pay a tax bill or pay an insurance bill from that.
Correct. Yeah. The business money market accounts we have limited transactions in and out.
Right.
And then if we get even a higher rate, I know CDs right now, 3%, right? But you've got to lock it in for 6 months.
Yeah.
Which most of our cash reserves, that's not really what we're looking to do for them. If we're getting 2%, 1.5% in a money market account, that's fine. And then there's I bonds, which are like 10%, but that's not really something we can participate in, right? Those are great individually, but you can only buy one.
You can buy one per really individual entity. So like you could buy one, your wife could buy one, you could buy one for your kids, and the limit is $10,000 per entity that you have. But I don't think you can go out there and buy them for all the business.
Yeah, the I bonds are amazing. I bonds right now are paying 9.6% when I looked it up yesterday. And you have 4 kids and a husband and a wife, you can get $60,000.
You just need to have more kids.
So you have more kids, because that $10,000
that's a solution to make more money.
It's paying 9% now. So it makes me remind myself that I need to open up one more for my kid, because I only opened up one for my wife and I. So I got one more to go.
Yeah, but those are more geared towards individuals.
Yeah, and it's
obviously
it's got a $10,000 cap per person too. So that's a very
So in
they're
theory,
cumbersome to do.
Yeah, they're cumbersome.
We could open one with a business, but it's gonna be a minor impact on.
Yeah, and we have hundreds of thousands of dollars sitting inside some of these reserves account, or $100,000 plus, or whatever it is, $10,000.
No, some of our deals we have $700,000-800,000 in reserves, especially if we look at deals like TVTC or Johnson Square. Like, these are large commercial buildings that have substantial costs associated with them, and especially from a standpoint of either leasing commissions or TI that have to get paid out. So we couldn't put that money in something super long term, but we could do a 2-month business CD or a 3-month business CD. But it's definitely something that we are working on a deal by deal basis to maximize interest that we are earning. And it kind of rolls up in our other income on the reporting line, but it's definitely something we are earning interest on currently. And that's why, we switched to Service First Bank maybe 4 years ago. They had, at the time, they were very convenient local bank, the aggregate of credit unions that has provided us with the best rate on our savings account. And that was even 3 years ago when they were like, no
yield.
There was no yield on business savings accounts. So, okay, let's see. Well, next question is also a little bit of a discussion. And trying to do math is always exciting. But if we look at, so the question here is, how is rising rates going to impact loan payments, and what opportunities do you see there? So for us, and we've talked about this kind of at length on the debt side.
This is an easy one for us.
Yeah.
Have fixed rate debt. We don't rounds, and most of our loans, we can predict they're going to cost over the next 5
Right.
years.
Yeah, ours are,
It's easy.
we just did our one refinance that we had for 2023. That was coming up. We finished that in the Grove. We don't have anything else. We don't really have anything else to do
Yeah.
on the debt side other than wait until 2025, 2027.
Well, hopefully we're buying deals too. So we do have to do
Correct.
some
But
stuff
that's
with
where
debt.
that's where I think this comes in, and we look at floating rate debt. So even on expensive assets or higher end assets that were trading at like the 3 and the 4 cap range, if you had a $10 million deal trading at a 4 cap, that means it essentially had $400,000 of NOI.
Yeah, so your cap rate is, to slow that down for a second. So your cap rate is basically your yield on your costs. So to invert what Dave said a little bit, if you pay $10 million for an asset at a 4 cap, you're basically earning $400,000 a year before your debt payments, before any kind of leverage. So just to clarify that point.
So that makes it pretty easy. You got $400,000 of revenue to pay your debt. When debt was 4%, right? You've got, or even 3%. Some debt was pretty low. We have debt that's 2.7%. These are pretty low numbers, but a typical real estate deal has about 75% loan to value. So a $10 million deal, 75%, you get a $7.5 million loan, 3% on $7.5 million. You're paying interest only. So that's $225,000.
Good job.
We're doing some math. Yeah.
We'll see how far
We're
we can
moving,
go
yeah.
before we can mess up all of the numbers. But in that scenario, you've got NOI of $400,000, $225,000 of interest cost. So you're making 175 grand a year on your investment. You invested 2.5 million, make 175,000 a year. There were a lot of deals that were getting done at that level. And the opportunity now is that interest rate is now 6%. What's the latest? I mean, we did our multifamily loan at 6.3%. That we just did.
And we were thrilled.
And we were thrilled.
Yeah, because the 10-year, I think it was around a 250 basis point spread on the 10-year treasury. At the time we
Well, here,
locked
let's
it.
back up. What do you mean?
Oh,
So
okay.
250 point spread. So there's interest rates that are like published, like the Fed rate, right? And then we have to add the bank profit on that,
Yeah,
right? The spread, which is another 250 points or 2.5 percentage points.
right. Exactly. So the 10-year treasury right now is give or take 4.1, 4.2. I think it shot up to 4.35 last week, but let's call it 4.
Let's see if Alexa will answer that one for us. We don't-
And so let's call it 4. So that's your variable rate. Your fixed addition on that is basically the banks have a fixed profit rate. So they want to guarantee that they're going to have to make at least 2.5% above that. So we were locking the Grove. The 10-year treasury was moving insanity.
Well, it moves every
over-
day. It's all
Yeah,
over the place. It's
just a
kinda crazy
lot
too,
though.
right?
And so, we locked at right around 6.3. And I think it would have shot up to about 6.6, 6.7 if we would have held on much longer. So we were thrilled to lock there.
Yeah. So we locked that loan in about 30 days ago, our
Yeah.
rate.
And I just received a recent quote for a new deal we're looking at right now from one of our regular lenders. And can you guess what rate I just got?
Is it over 7?
It's not over 7. It was 6.75. So I don't know how much that counts, but
Yeah, it's still high.
yeah. And when you're buying something at a 7 cap or a 7.5 cap and you have 6.75% debt, the spread between that is, you just don't do the deal.
So with that, I mean, those are the rates we're seeing right now. That's where really the opportunity can come into play. So if we go back to that $10 million deal that has $7.5 million note that costs $225,000 a year because it's 3% interest on $7.5 million. And now that interest rate is 6.5.
Just call it 6.
Let's just call it 6. Josh wants it to be 6. He's more optimistic.
There's some mental math, and I'm not going to get.
Let's call it
6.5.
6.375 and see what we can do there. No, so let's say it's 6% on $7.5 million. You got that?
I got that one
Ed?
pretty good. Yep.
What is that one?
Oh, 7.5 million.
Yeah, there you go.
You lost me again.
I know you can do
Yeah.
6% of 10 million. But
Yeah, let's call it 435-ish of an interest cost.
Real-time math.
$450,000.
And our If we go back to
And we
it,
make.
we make
we only
400.
we only make 400.
So I guess we're not going to do that deal.
Right. So that in that situation, that deal, they cannot refinance
Well,
that $7.5 million.
They already did that deal and they had floating rate debt and it was 3%. Now it's 6%. So now they're,
Yeah.
the point is that
Gosh,
now they're
We could have
underwater.
just done 225,000 times 2.
That's where I was trying to go with it, but yeah.
It's embarrassing. We'll have to delete that part out on our math.
Oh,
We're normally better at math than that,
the
folks.
slide, by the way, you can't delete.
I
this.
know.
Okay, yeah.
We'll do the matrix of like the zapper thing.
Okay.
That's Men in Black. Anyways, so $450,000, you're now negative. And the bank was going to require a debt coverage of 1.3. So the reality is with 6% interest, you can only get a loan for maybe $5.5 million. So to do that refinance, the owner of a $10 million property is going to have to bring $2 million to the table.
Because their current loan is 7.5. Now they can only get say 5.5 or 5. And so they're gonna have to come out of pocket.
Right. And that's where we see a lot of opportunity. That, we don't really have that on our deals because our loan to value is around 44% normally on average. And all of our loans are fixed through 2025 and 2029. So we don't have a lot of that in our portfolio. We really have none of that in our portfolio. But the market as a whole is going to see a lot of these opportunities come up where you have what was a $10 million deal and now the loan is coming due and they are not able to refinance that loan unless they convince whoever is the equity chunk to go write another check for another $2.5 million. So you could either be in a position that you want to double down and double your investment into something, or you just say, I don't want to. And at that point, we're going to see stuff that is going to require some deleveraging capital or some capital that can come in between the original investor capital money and what the new bank is and make up that difference. And they're probably going to be able to do that and command some special terms in the deal or take full control, most likely take full control of it. There's probably going to be a dilution of that original equity in that situation. So that was a lot of math in one scenario, but I think the short of it is just that as we see interest rates rise and it's more expensive for debt, anyone that has floating rate loans or anyone that has loans that are coming up in the next 12 months are going to be in for a challenge. So after that, who knows what happens after 12 months? Rates may come back down. I think they're probably going to stay. I mean, 0% rates are not something that is a normal function of, I don't know, capitalist economy. So they've always been above zero. So we had this random period of time where they were at zero essentially. So I don't think they're necessarily going back to zero. So there'll always be some level of interest. Now these loans are going to be requiring this deleveraging capital.
Yeah, a lot of the discussion in the cover pages that went out. There's a block on really the last paragraph of most of them that basically said that, over until our loan comes due, if our loan comes due in 3, 4, 5 years from now, we really have to work on improving our net income to afford those higher rates. We don't believe that we'll see the 2.7s, the 2.9s, the 3.1s again, that we need to prepare for 3, 4, 5 years from now to be more moderate rates, which would be in the 5s or 6s, which is, historical normals.
Yeah. I mean, we were excited about getting loans that were 5.5%, 5%. We were like, let's lock that in long term. It still sounds pretty darn good. Our typical deal, though, being a value add, being a cash flow generating deal, we were 5% was fine, especially on the multifamily side. 5% was fine. It worked all day long.
So what kind of other questions do we have?
You don't want to talk about that one anymore?
I think we talked about that one a
You're
lot.
done with that one.
Well, there was a lot of math and you were getting confused. I don't want to.
Now, we can talk about our carnival that's happening in the next 30 minutes.
Yes.
So we've got a big event that's carnival, kind of our fall event that's in 30 minutes from now.
Yeah.
That's going to be right here, right outside.
Yep.
Everybody should drop what they're doing right now.
Drive over to Norcross,
Head
Georgia.
on over to our office and you'll have lots of food.
Yeah, we've got food, we got everything.
Drinks,
So,
fun.
It's warm outside. It's a beautiful day.
yeah,
Anyone from California watching this, we have better weather than you right now. It's pretty great.
Do we have any more questions?
this is kind of just around cap rates though, of like, it's hard to just project where our cap rate's going to be.
Oh boy.
That's a
Crystal
hard,
ball, where interest rate's going to be, where a cap rate's going to be, where prices
Yeah.
go.
I know that one's hard to answer, and I don't, obviously if interest rates go up, cap rates have to go up as well. There always has to be some kind of spread.
Yeah, we expect prices to go down over the next 6 months, but they haven't so far. They've gone down a little
Yeah,
bit.
right
Like,
now.
the brokers are saying
Right.
50 points
Yeah.
on the cap rate, maybe.
So there's definitely going to be movement, but there's always movement within the market. And as rates go up, deals also just have to make more money. They have to produce more money.
Right.
I think something that happens, and I mean, we're seeing that. We saw our revenues go up substantially in multiple types of assets. Industrial has seen huge revenue growth. That huge revenue growth in industrial, though, is to be able to generate more yield, pay higher costs. It's really what they're doing. The industrial deal that we talked about buying with $2 to $3 rents, like the cap rate we're buying that at is essentially a zero,
Where it's a nil.
right? Like that deal doesn't make any money, but we're buying it because we know even with higher interest rates at 6%, we can charge enough to make a good spread above that. So we're more looking at not cap rates, but we're looking at, I mean, cap rates are important, we're not ignoring, but it's like, what can we do in a deal to find the largest spread we can against the debt that we have?
So value add, what are
Right.
you doing to fix the problem, fix a piece of paper, a lease? What are you doing to fix a tenant problem?
Yeah.
What are you doing?
And that's really what we've always kind of focused on. We've never really focused on what are we going to do with value. We're going to focus on generating cash flow.
Yeah. So what investors should see from us in the near term is it less so of this is a flat cap rate, a flat yield, and we're just going to make some spread on it. More so that we're going to go in, we're going to renegotiate this lease before we close the deal, like we just did with IHOP, and make this fantastic story before we close the deal, and then have a great cash flowing asset locked in place.
We're working on the industrial deal right now
Mhm.
on the east side of Atlanta, where we can go in and do a bunch of work for a tenant to make it more custom for them, so they want to stay there long term. And I mean, that's a big industrial complex that the tenant has outgrown sort of ish, or their needs have changed over the year. And if we can go in and improve that asset and get them to sign a longer term lease and fix our spread with growth above a fixed interest rate, we're in good shape.
Yep.
We like that all day long. So that's really just what we're looking for on all of our opportunities we see going forwards. Okay. See if we have any other questions that come in. We don't have any other questions here, folks. So thanks for joining us, and
We'll see you in
Yeah.
see
30
see you in
minutes at the
30
carnival.
minutes.
Yep.
But yeah, and again, everyone's statements came out on the 20th. It's all in your investor portal. And by now you should have received all of your distributions too. So thank you very much. And we'll talk again fourth quarter, which will be